This week's edition of Landlording for Life is brought to us by our good friends at Audible.com. Go to audibletrial.com/landlording and preview over 180,000 titles. At the same time, get a free audiobook download and free 30-day trial to all of our listeners. Now on to this week's podcast.
This is the Landlording for Life podcast, where landlords explore their success and stories of failure while building a foundation to improve upon. Here is your host, Sean Morrissey.
Hey everybody, welcome back to another episode of Landlording for Life for this week. Appreciate you tuning in as always. And today we're going to talk a little bit about investing in fourplexes. And I am honored to have on a gentleman by the name of Steve Olson with the Fourplex Investment Group, or better known as FIG, out of Provo, Utah. And Steve specializes in fourplexes. So I wanted to have him on today to really familiarize myself as well as our listeners on why fourplexes are such a great investment for the aspiring landlord and kind of go from there. So Steve, welcome to the podcast.
Hey, good to be here. Happy New Year.
Yes. Happy New Year. As at the time we're recording this, we're at January 3rd of 2020 and ready to see how 2020 transpires for each and every one of us. But yeah, Steve, I was hoping you might be able to dig into just your background a little bit and why fourplexes are the investment of choice for you and your team.
Sure. Yeah, I've been in real estate since 2002 in one way or another. And I joke with people that, it's kind of like dog years. So since 2002, that means I've been in real estate for like 100 years.
Yeah.
Based on everything
well
that's
said.
happened since then. Yes. I actually got started on it in college, just doing some wholesaling and a few things like that. And because I thought I was going to be an attorney and I thought I could go flip properties and do wholesales and just pay for law school.
Well, this is much more fun than that.
A lot more fun. And the light didn't really go on right away to where you'd think, hey, if you can do that stuff well, why would you go to law school? But I guess we all got to realize this on our own, right?
Yep.
The point is that I eventually did. And I've been involved in all different kinds of real estate ever since then. Single family properties, raw land, multifamily properties, flipping, wholesaling. Even did some of those Fannie Mae bulk tapes that they were called. I can't even remember what a tape stands for anymore. Something about toxic asset, and I forget the P and the E. But those were a few of those were going around during the real estate crash. But
yeah, 10 years ago.
Yeah. A lot of what I do and how I think about this business revolves around what I learned during that time, because I remember in 2008, it was really tough. If you went through it, you remember it exactly and how it all unfolded. But, for me, what was interesting is everybody wanted money. And it seemed like the only people that wanted to give me any money were my tenants. So I thought, okay, this says something to me that, I want to be invested in rental properties because paying rent is generally a very high priority for most people. And I like to be people's highest priority.
Yeah, I like that. That's well stated. Yeah. That's the one thing. I'm a survivor from 2008 as well, and that's a great point. The one thing that you could count on is that rent check, putting a roof over somebody's head.
Things have to get pretty bad for people to not make rent, and so just playing the numbers, that's a good place to be. To where, hey, that's one of their main priorities every single month. And so, since then, I really have been involved in the rental game. I've done a lot with single family turnkey properties. And especially getting into fourplexes. I like fourplexes. You'd kind of ask why I work in those so much. And it's not the only thing I do, but it is the core of our business model here at FIG, the Fourplex Investment Group. And I like them. One reason being is that they're recession resistant. I'm not going to say anything is recession proof. Maybe a bunker with a bunch of gold and bullets is recession proof, but you got to be out there. You're going to have some exposure if you're going to invest. And so they're really recession resistant for a couple of reasons. Fourplexes are this interesting hybrid that land in the middle between multifamily and single family. One of my associates over here, Steve Bond, says that it's like fourplexes are the edge of the coin. They're not heads or tails. They're the edge. And so The reason being is if you look at multifamily properties, those are an excellent hedge against recessions because of the multiple streams of income that come from them, right? You got a whole bunch of people that are obligated to pay you rent every month. But the slight problem with that is the terms of the financing, right? On a large multifamily property, you're going to have to refinance or pay a loan off every 10 years, right? Those aren't fully amortized loans. They've got balloon payments on them.
Correct,
for the most part. And so you don't know. Now, if you're a professional at that, you know how to play that game. That's okay. But if you're a mom and pop investor, or maybe you're a physician or somebody that's a high W-2 earner, the highest and best use of your time, that's a real estate term, is working in your practice, making money, and you're not a pro at dealing with that balloon aspect of commercial financing.
Yep.
So a fourplex is really great because we do get those multiple streams of income. We've got 4 tenants, but we have the good side of single family investing, which is the true 30-year fixed rate, fully amortizing loan. Right now, those loans are coming in on fourplexes or, in the low 4s, mid 4s on the interest rate. And if you can make that payment every month, nobody's coming to you holding their hand out in 7 or 10 years. Or saying, hey, your interest rate is different now. It adjusted upward. That was a big thing responsible for the crash in 2008, was these adjustable rate mortgages all of a sudden doubling people's mortgage payments overnight. You're not going to have that problem. So you've got 4 tenants that you can work with on your income streams, and you have longevity, right? You have longevity to make it through these uncertain periods. Because if you're not a pro at dealing with the balloon aspect of commercial, you don't know what the economy is going to be like, what the financing markets are going to be like in 7 or 10 years when you are obligated to refinance or to pay off. I think another thing too, a client of mine mentioned this to me. He bought a couple large properties through us. On commercial, you have to report to the lender periodically about, hey, here's where my rents are, here's where my expenses are.
Yeah, annual
and
audit.
They can call for, on a 30-year fixed rate mortgage with a fourplex. Really the only requirement is make your payment.
Yeah.
There is no annual audit, right? So they've got that longevity. And I just want to clarify, I'm not trying to say commercial or single family is bad. I'm just pointing out some pros and cons of all of these that, anybody would have to acknowledge. So I really like fourplexes for that reason. And you're going to get a little bit additional liquidity with them as well, because there's just a larger market out there for fourplexes.
I think what you mentioned there regarding the balloon aspect of the commercial side is really important. It's one of those things that I don't necessarily think about, is the fact that you can't necessarily control economic conditions or understand where rates are going to be 5-10 years from now when those balloons are up. And by locking in 30-year fixed over the course of time, you can be the simplest of investor, and as long as you can make that payment, you're in good shape.
Yeah. And I don't think that that's like a huge problem, right? The bank is making that loan to you because they think you're going to be able to pay it off or refinance it in 7 to 10 years. Yeah. Right. They think so. Banks have thought things before. So it's just an uncertainty out there, and so that's why we say, hey, they're recession resistant. They're a good option for somebody that's cognizant of that. Yeah, fair enough. So what states do you operate in currently with FIG? So FIG was born here in the state of Utah, and really kind of by, I don't want to say by accident, but your instinct is to start operating in your own backyard, and that's what happened here. And we caught lightning in a bottle. It was at the beginning of a massive upswing in the state. Things have gone well. Unemployment is really low here, and just a lot of tech and other businesses coming into the state. And that kind of led us to believe, though, that hey, this whole fourplex philosophy, if it works here, shouldn't it be able to work somewhere else? And so we're looking for areas that are landlord friendly, where we can actually hire people and build and operate, and that have diverse employments, right? So we probably kind of an odd fit, but we did it as the next market was in Houston, Texas. Okay. We did a little test project there of 40 doors, and it went okay, right? We those are all leased up and they do well, but we certainly learned a lot from a development and construction standpoint. Texas is kind of like a different country. They'll be the first ones to tell you that. They'll proudly tell you that.
Yeah.
And so there are a lot of different things that we learned in Texas, but we're on our third development there now. So we've continued to march forward there. A good fit for us being here in the Salt Lake City metro was Boise, Idaho. It's not too far away on many of the development and
awesome market.
Construction. Yeah, it's a great market. And right now we're working on what I think is another really great fit, which is Phoenix, Arizona. We have land under contract down there. We're about to start marketing for reservation our first project there on the west side of the Phoenix metro. So that's where we are now. And I think if we could have it our way in the next 5 years, we'd probably be in Colorado and then maybe in Reno, Nevada. But we're going to have to see how things work.
Yeah, no, fair enough. And, I'm fascinated by the fact that you were able to scale to other states, well, like Texas, right, that would be considered so far away from Utah. It's one of those things I've always struggled with. And I'm wondering, what do you recommend investors do when they consider investing from a distance or in another state? What systems do you think have to be in place to have it make sense?
Well, the bottom line is that you have to have a team that you can trust. Many of the sides of real estate investing involve having a team, whether the property is 10 minutes or 1,000 miles away. Okay. And sometimes those things, it doesn't matter that you're close or that you're far, right? People tell me all the time, well, I'd like to be able to go check on it. And I'm thinking, well, what are you going to do? And what are you going to check on? You can't enter, right? Tenants have lease agreements in place. Are you a construction expert, right? And if you are, then great, right? But I think that investing in distance from another state is all about having that trusted team. And then also you being a very educated investor who has done your due diligence and who understands the market. I think probably one of the best ways to do that and to get comfortable with that is to independently confirm and verify the rents. Okay. The reason I say that is that many of these other problems that can stack up on you as an investor, and this can happen locally or nationally, all of those problems can be overcome if you've got income. If you've got rental income coming in, we can get past nasty repairs. Right? We can get through an eviction because we know the market is there, that we can get another tenant in there quickly. Right? So you have to just make sure that you understand the local economy. Who are these tenants? Where are they coming from? What are they willing to pay? What is the vacancy like in the area? If you know that, then I think many of these other problems become a little bit secondary. And they're a lot easier to get past. But a lot of our investors really overcome it because one easy thing to get your head around, right? I think a fear that an investor is going to have is if they're buying 1,500 miles away is, how do I know I'm not buying a piece of junk? Yeah. Yeah. And when you buy new construction and you know that the bank is doing an inspection, you have a right to do an inspection, right? There's an appraisal, there's multiple qualified eyes on this deal. That certainly is going to help. Because it's new. We've got warranties in place, right? We've got insurance, and we have actually HOA on ours. I know that as an investor, the lawn's being mowed, that the premises is being taken care of, right? That the community is being upheld. So those are secondary things that I think about. But first of all, income. And then I think build off that to expenses. Know what it's going to cost to operate it. Know how much you can make doing it. And then we can get past these other things. Okay, I like it. Yeah, always lead with income, and then you can kind of work through the details from there. Now, are fixed projects, are they all new construction, or is there any kind of value add play on repurchases? We're all new construction, but I can kind of give a little bit of asterisk to that in just a second. But we joke that we're an armchair value add. Okay. Because what is a value add? It's we find an underperforming asset and we spend the time and the money and the effort to bring those rents up. Yep. Right. And so correspondingly, we've added value to the property. It's now worth more than what we paid it. So, hey, what's your game? Is it take the additional income, refi, pull some money out, sell? There's multiple strategies that you could do there. But to a busy professional that we deal with, they're not going to go do a value add. They don't have time or the know-how to go do that. No, that's but new. That's fair. That's good. Yeah, but new construction in and of itself can be a value add. The way we do it is we sell the property on a pre-construction basis, and we set the owner up with a construction loan.
Okay.
And so you've heard the term forced appreciation, right?
Yep.
That's essentially what we're doing here, because when you take a piece of raw land and then 12 months later there's a fourplex sitting on it with tenants in it, right? You've forced appreciation there.
Yeah, no, that makes
you've brought
makes
that
sense.
up to its highest and best use. And so that's why it's an armchair value add, right? You go through the new construction process with us, and then you can kind of get some of that upside, because your alternative is to go pay retail, right? Hire an agent, go out on the MLS. Let's go find a fourplex.
Yeah, and then try to find that value add, and that's becoming more and more difficult.
Yeah, exactly. And if your listeners have gone through the process of what I just said, which is get an agent, go find a fourplex on the MLS, they're rolling their eyes right now, because it's really, really underwhelming what's available out there. People are willing to pay insane prices for built and occupied fourplexes right now. And hey, our clients sell them all the time to people doing a 1031 exchange, right? They'll sell them for $100,000 to $150,000 more than what they bought them for. And I guess, if you're looking at something like that in Salt Lake City, Boise, or Texas, somebody coming in from San Jose who just sold their shopping center, them buying at a 4 cap for a new construction fourplex and getting out of their capital gains, that's a really good deal, because you can't buy an outhouse for less than $700,000 in San Jose, right?
Yeah, fair enough.
So it's all comparative, but the value add comes through being willing to go through that new construction, take on a construction loan, and accept some of the uncertainty that comes with that, right? Because you don't ultimately know what your end interest rate is going to be. You don't know for sure what your end rents are going to be. You can just bracket that. You can get to a point where you go, okay, I'm pretty sure it's going to be about here. And is this a good deal to me?
Yeah, fair enough. Now, with them being new construction, how are utilities handled with the tenants? Are they all rubbed out so that the tenant's paying those, or does it fall on the landlord to some capacity?
That's a good question, and it's another point where we kind of fall in the middle. We don't do rubs on these things, because you're essentially looking at a master subdivision where maybe there's 40 fourplexes in there, all with different owners.
Yep.
The HOA that we put in place is actually going to handle the water, sewer, and garbage, as well as all the landscaping, maintenance, pool, snow removal, clubhouse, right? That stuff is handled as a part of the investor's HOA dues. Then the gas and electric is all metered out separately per unit, and that's charged to the tenants.
Okay, very good. Well, and it's funny, around here in the Chicagoland area where I'm at, I can see different multifamily buildings that were constructed, let's just say late 70s through the 80s, right, without associations in place. And those are some of the, you're completely dependent on your landlord maintaining their building, right? And they're so underwhelming in terms of their condition that, boy, having that association is, it's almost a requirement in my eyes. And the fact that you can maintain those grounds, those common grounds, really, that are shared from building to building. So kudos to you for putting those in place, because that's one thing I see that should have been done here years ago. And, unless you were to buy back the majority of those buildings, it's just not going to happen.
That's such a good observation. And it's usually one that I have to kind of bring to people's attention, but I love that you see it, because HOA can be a dirty word in the investor world, right?
Yep.
They think of, it's this big behemoth bureaucracy that just is going to charge runaway assessments and gradually erode the value of my investment.
Yep.
And you know what? That can happen in a single family community where the owners that live there are the busybody members of this HOA, and they're always just in the middle of everything. But conversely, look at these subdivisions where there isn't an HOA, and they were built 30 years ago. What do they look like now? Is that what you want?
Yeah,
right. So you have to watch that. And you made a good observation, because I was down in Phoenix a couple of weeks ago, and we were at the institutional single family investment conference there, just seeing what we could learn. And during breaks, we were taking off and viewing various land parcels and kind of talking to property managers. And we were looking at this one parcel where the rents that we felt like we could get, we were a little concerned about, because we could see that in the immediate neighborhood around the parcel, there were single family homes for rent for about the same price. And really, if you kind of analyzed it on a, bang for the buck analysis, in those single family homes, people were just getting more square footage, possibly an extra bedroom, for about the same price.
Yeah.
So we're really trying to be objective. We're going, well, why would somebody come rent our 2-bedroom townhouse or our 2-bedroom flat that we're doing? And so we pose that question to some property managers that are managing some of these big build for rent communities that are showing up in Phoenix. We're saying, why would somebody do that? What are we missing here? And the universal answer was, when a tenant is renting from the mom and pop single family owner, they are more and more feeling like they're getting a poor service experience.
Wow.
Because a lot of times they'll say, hey, my toilet's broken. And the owner is saying, well, go, call Angie's List and just send me the bill. Right. They're not getting very good service. So they're having to go initiate these repairs, whereas they want to live in a community where I don't have to think. I can text the property manager and say, my sink is clogged and it is handled that day. It's not my problem.
Yeah,
I don't have to think about the lawn or the grounds or anything. And more, the millennial demographic shift is going that direction. And I think that's another reason HOAs are important.
Yeah, and it's funny to think of an area like that where the stigma against the mom and pop landlord is so bad that they would yearn for multifamily dwelling, I suppose, just knowing that there's professional management in place. That's an interesting conversation.
Isn't that crazy? Yeah. I think that 20 years ago, that was just blasphemy. People would say you're insane, but you can't deny it that we see it too, even with some of the baby boomers. People are simplifying. They want a more simple living experience. They don't want to have to deal with this stuff.
Yeah.
And so these older communities where there wasn't an HOA, well, you're going to be dealing with that stuff. You're totally dependent on a landlord who may or may not be competent. You don't know.
No, I think that's a fair statement. So for those listeners out there that are actually involved currently in single family, how might you recommend that they transition from a single family setting to a multifamily? And what are some of the advantages in investing in multifamily?
Well, you're really just playing real life Monopoly here, right? I tell investors that the last time you played Monopoly, did the guy that win have a bunch of greenhouses, or did he go to the right hotels?
Yeah.
Right. Maybe that's an oversimplification, but it's fun to say. So I say it. But it doesn't mean that there aren't great single family investments out there. I have a couple myself still right now. I like them. They're doing well for me. At some point, my equity position in those is going to get to be where I convert it to a fourplex, because I think there's economies of scale that come with the fourplex. I don't know any people that have 50 single family homes and aren't thinking about a way to simplify their business. Now, that may be that they retain the homes and they continue to do that, but they've got to hire more and more people. They're running a professional company here. But for a mom and pop investor, really, fourplexes are a more efficient use of your time and your resources, especially your limited loans, right? When we talk about those conventional fixed rate mortgages, the 30 years, you can only get 10 of those in your name. And it doesn't matter if you have $1 billion in the bank, you get 10 loans, right? So wouldn't you want to pick up 40 doors with those 10 loans instead of 10 doors?
Well said.
That's the thought.
Yeah, no, exactly. I think that's kind of the Trump character, is the fact that you can get 40 doors for 10 loans rather than 10 doors for 10 loans. Yeah, and hopefully those listeners out there that still have those loans available to them will take that into consideration. One question I'm kind of dying to ask you here is how you see the market playing out in 2020. And I know markets are local and all that good stuff, but on a national basis, how do you feel about the market heading into 2020?
You know what? I love this topic. I really do. I get into it with people and they think I'm a weirdo. And I'm going to butcher a quote. I'm probably going to attribute it to the wrong person. I think it was either Andrew Carnegie or John Rockefeller. but probably neither. Like I told you, I was going to butcher it. That said something to the effect that he knew it was time to sell his stocks when the shoe shine boy was giving him tips. And I'm going to kind of take a back door to that quote, because I hear so many people, especially the millennial generation, saying, yeah, I'm going to wait to buy until the market bleeds out 50% again.
Yep.
I hear the talk of, oh, well, recessions happen every 7 to 10 years. And these aren't, Rhodes Scholars saying these things. This is just the everyday common person on the street that really has limited knowledge about real estate. I'm not trying to belittle them. It's just they don't know very much about real estate. It's not their business. And so whenever I hear everybody saying something, my mind starts to wander to the opposite. Because they say, well, recession 7 to 10 years, they say these things. And that's all true statistically. Yet I'm having a hard time finding the reason why. Now, yesterday, the U.S. just killed an Iranian general in Iraq.
Yeah.
And who knows what that's going to do, right? We have world events. We have things that can happen that set things in motion. But when I look at this business, and I think it's a mistake to compare it dollar for dollar to 2008, because what we saw happen in 2008 was really runaway supply and demand problems, massive home building and selling those homes to people that ultimately couldn't afford them.
Yep.
And so you have in 2008, all the financing, almost all of it dry up nationally. And that was a national thing. The financing was a national problem. And then we had all these houses coming online, and it got to the point where the supply was so out of whack with the demand because the loans weren't there that, yeah, you could literally go buy homes for cheaper than you could build them. And that historically does not really happen very much.
And it's not where we're at in today's market. I mean, it's, yeah.
Exactly. I don't see that problem right now. I don't see this massive influx of inventory that is going to create a situation where we can buy homes and properties for less than we can build them.
Yeah.
If anything, people are clamoring for builders to get off the sidelines. And those subcontractors that left the business in 2008, the tile setters, the framers, the electricians, right?
Mm-hmm.
I don't think they've really come back.
Agreed.
And
yeah.
I don't know where the subcontractor base is that is going to suddenly allow for this influx of new construction to just flood the market with supply. My wife and I are building a house right now for ourselves. And I don't think any of these subcontractors that we're dealing with are under 45 years old. So until we see younger people or through immigration deal with the subcontractor problem, I think home values and real estate values in general at worst are going to go sideways, but they're probably going to continue to go up.
Yeah.
The thing holding them back is wages, right? There's only so much that people can afford. So that will be what keeps a leash on the prices, but unemployment is really low. Wages has actually been coming up a little bit. It's the first time I've seen anybody talk about that in a long, long time.
Yeah.
So, recessions happen every 7 to 10 years, but
doesn't look like we're there yet.
There's always that caveat of some world event and craziness like that, but people are working, people are making money. They need affordable places to live. And so I think that, if you're that person waiting for the market to bleed out, you're going to be staring out the window longingly.
Well said. Well said. So second to last question here. For those listeners that are in the part-time investment phase, or maybe they're just digging in and getting started, how would you recommend that they go from part-time to full-time, quote unquote, financially free? What actions need to be taken?
Well, I think you first have to decide what financially free means, right? What does that mean to you? What dollar amount is it in passive income? Okay. And you have to start then. You have to say, okay, if I need $10,000 a month, right? Let's make a start. Let's get to 1,000. right? However that may be. I think that you are going to accelerate that process by not just thinking about cash flow, but by also thinking about taxes. The way the tax code is written, it's almost like they're begging us to invest in real estate.
Yep.
There are so many benefits that come from investing in real estate, and taxes are the largest expense you have in your life. And so how can we every time we add cash flow, we can also lower taxes. So I think that one of the quickest ways to do that is to get to become a real estate professional to where you can lift that cap on depreciation.
Yep.
Right. So most people that are working only have so much depreciation they can take. Eventually, you're going to get to a point where can you go part-time because you've got enough rental income and then become a real estate professional, and then you juice it even more by the tax savings that you're getting. People who are married actually have a unique opportunity there, right? If you've got a spouse that's working and is a high W-2 income earner, the other spouse can be the one that's the real estate professional. So you can kind of have the best of both worlds. That money can keep coming in through the job, but you can get supercharged tax benefits through the other spouse who's a real estate professional. And I'm getting into the weeds there, but I think that's a great way to do it.
That's a great point. And ironically, and it's not by purpose, but that's how my current life is structured. So I appreciate you bringing it up. That's fun stuff. But okay, cool, man. Well, I tell you what, this has been a lot of fun. I feel like we can go on for like another hour because
we probably could. Yeah,
you're a high level guy, and I appreciate your insight. But what's the best way for folks to learn more about FIG? And I should mention, I was checking out FIG's blog prior to our conversation here, and really some awesome stuff. So I recommend everybody check out the blog. But Steve, go ahead and give them the website and the best way to reach out.
Yeah, just go to fig.us. That's our website, fig.us. And yeah, you can see our blog. We're always putting out more information about the market and what we see happening there. You can see lots of cool progressions of the developments that we've done, drone footage and kind of how things are moving along. To just give you some examples of what we're doing, you can see current projects. Like if you're in the market for a fourplex, we've got some posted up there that you can look at and analyze. And you can always fill out a contact us form if you want to talk, and just say that Sean sent you over. So we'll know that we need to treat you right.
Appreciate that.
We would anyways, but we like to know. So that's how you do it. Just go to fig.us and reach out to us there.
Very good. Well, thanks so much for taking your time to talk to us today, Steve. And thank you so much, listeners, for tuning in this week. We will be back next week with another episode of Landlording for Life. For the time being, enjoy the rest of your week, and we'll see you next week. Bye-bye.
Thanks for listening to another episode. If you like what you heard, leave us a 5-star review and join our Facebook group to share your deals and ideas by searching @Landlording for Life. See you next time.